Hello, everyone. I'm Sean Garcia, Marketing Manager here at Mazars in the U.S., and I'd like to thank you for attending our webinar. Today, we bring you the second webinar in our Reit series, Impermissible Revenue and TRSs, which will be led by Craig Stern, Donald Zeef, and Patrick Oberleaf. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the available 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of your screen. Now, thank you once again for joining, and I'll hand it over to Howard Landsberg, a partner here at Mazars.
Good day to you all. I'm Howard Landsberg, and I lead the real estate tax practice at Mazars in the United States. I'd like to welcome you to the second installment of the Mazars Reit webinar series, Impermissible Revenue and TRSs. Mazars is a leading international audit, tax, and advisory firm. We operate as a united partnership, as one integrated team who leverages our expertise, scale, and cultural understanding to deliver exceptional and tailored services around the globe. Mazars has more than 24,000 professionals operating in over 90 countries and territories. Throughout the webinar series, you will learn more about the Mazars Reit practice, our experts, and technical Reit subjects. Today's webinar, Impermissible Revenue and TRSs, will be led by Craig Stern, Don Zeef, and Patrick Oberleaf. Craig has more than 30 years of experience in the real estate and investment industries with a focus on transaction services. He has worked on over 100 mergers, acquisitions, dispositions, joint ventures, inbound investments, and spin-offs with deal sizes ranging from $1 million to $6 billion. Don also has more than 30 years of experience in the real estate industry focusing on REITs. He is the co-author of the Real Estate Investment Trust Handbook, published by Thomson Reuters. Patrick has more than 7 years of experience in the real estate industry. Thank you, and here it is off to Craig to start us off.
Thank you, Howard. Good afternoon. My name is Craig Stern. Today's agenda will be in 5 sections. Section 1 will be what is rent from real property. Section 2 will be what amounts are excluded from rents from real property. The third section will be examples of customary services. The fourth section will cover what services are considered impermissible tenant services. And the last section is what is a TRS. So as we discussed last time, there are a number of tax advantages for REITs and for their investors. Some of those advantages that we discussed last time were the pass-through of capital gains elected by the REIT, a Section 199 20% deduction for REIT dividends, as well as having the REIT act as a blocker for tax-exempt shareholders from recognizing UBTI and for foreign shareholders to protect them from effectively connected income from FERPTA. However, there are also various tax requirements that must be met to be a REIT. One of the key topics of the REIT is what is rents from real estate, which means what are rents and what is real estate. For equity REITs, rents from real property is the main source of qualified gross income for the 75% test. And real property is the main source of qualified gross assets for the 75% gross asset test. So as we look at the requirements, we look at what is included in rents from real property. The first item is rents from real property is rents for the use and occupancy of space. The second item that qualifies as rents from real property are charges for services customarily furnished or rendered in connection with the rental of real property, whether or not such charges are separately stated. And the third item is a corollary to the first item, where the first item talks about rents from interest in real property. The third item says rents that are attributable to personal property, which happen to be leased under in connection with the lease of real property, to the extent that the value of the personal property is less than 15% of the value of the real property. Rents attributable to that personal property will be treated as good rental real estate, even though it's personal property and it is not real estate. So what is excluded from rents from real property? The first category are any amounts that depend in whole or in part on the income or profits derived by any person from such property. This means that the REIT is supposed to be in the rental real estate business. It's not supposed to be in whatever business the tenant is in. Therefore, there's an exclusion to the extent that the REIT derives income from its tenant's business. However, there's an exception for amounts that are received just based on the tenant's gross percentage or percentages of their gross receipts or sales. So we often find that in leases dealing with hotels and with retail. The second category that's excluded from rents from real property are what we know as related party rents. Related party rents are any amount received from a 10% or more related tenant, subject to certain exclusions when the tenant is a TRS of the REIT, which we will discuss in section number 5. The third broad category of income that is excluded from rents from real property are what is known as impermissible tenant services, which will be discussed in more detail by Don. So the impermissible tenant service concept, introduced in the 1986 Act, basically refers to items that are non-customary services in a geographic area or services that are for the convenience of a tenant. However, there are exceptions. One is that a REIT can perform the same kind of basic rental services that tax exempts are allowed to render without creating unincorporated business taxable income, and that's under the Section 512 regulations. There's an exception for services performed either by an independent contractor from whom the REIT derives no income, or, as we will see in Section 5, by a TRS. And a third exception is that there is a 1% property-wide de minimis threshold. So you're entitled to have a small amount of non-qualified income so long as that non-qualified income is less than 1% of the overall income from a particular property. So generally, rents from real property were defined in the 1981 Treasury regulations, but they're very broad and they're relatively outdated in that there have been many changes since 1981, but generally they would say that rents from real property are gross amounts received for the use of and the right to use real property. So a very broad definition, and as we will see, the regulations do not require exclusive use and they don't specify a duration of use. They only ask that there is a use of the property. So historically, rents from real property were rents from buildings or space in a building, things that we commonly associated with rents, whether they be office rents, retail rents, apartment rents, the things that were prevalent 10, 20, 30 years ago. What we thought of as rents included CAM reimbursements, HUD subsidies, tax rebates, easements, payments. The rents were usually based on either square footage at a fixed amount or a percentage of gross. And then there were regulations that addressed what exceptions there would be to deriving gross receipts to determine whether or not it's really a net income lease versus a gross receipts lease. Modern day rents from real property are much broader. As we know, REITs have, over the last 10 years, have dramatically increased the types of investments they've made in real estate. Prior to August 2016, real property was defined in Section 856-3D, and those regulations separated what was real property from what they called assets accessory to the operation of a business. So they were trying to distinguish what is real property from assets that may look like or treated as real property from a state law point of view, but were not real property under the Internal Revenue Code. So, the things that they named as real property were buildings and structural components and other permanent, inherently permanent structures. And there was a court case by the name of Whiteco that laid out the criteria for what is an inherently permanent structure. The regulations also talked about assets accessory to the operation of business, which were the kind of things we would think of as not being real estate. Machinery and printing presses and transportation equipment and office equipment and refrigerators, so on and so forth. Over the last 40 years, the IRS issued revenue rulings trying to define whether certain assets were real property or not. And having grown tired of doing that in 1975, the IRS stopped issuing revenue rulings, but then entertained private letter rulings, and we received many private letter rulings covering such assets such as data centers, cell towers, boat slips, and billboards. Despite that, I think both the taxpayers and the IRS were tired of private letter rulings, especially since the world of real estate and digitization have expanded what people in the REIT industry were trying to invest in. So in 2016, the IRS issued new regulations, which were generally an affirmation of the existing private letter rulings, in which they explained what was real property. And they defined it in very broad terms. They said that real property included land and land improvements. Land included air and water and natural resources that are still in the ground. Improvements to the land included inherently permanent structures and their structural components. And they went on to define what is a building, what is an inherently permanent structure, what are structural components. They left in the new regulation the old regulation distinction between active and passive functions being performed by those assets. They also laid out whether or not a distinct asset was a structural component, and they also addressed intangible assets. For intangible assets, which often arise in acquisitions, they said there were 3 requirements for treating an intangible asset as an interest in real property. The intangible asset derived its value from the real property. The intangible asset was inseparable from the real property. And the intangible asset did not produce or contribute to the production of income other than in consideration for the use or occupancy of space. So basically, if the intangible was directly tied to real estate, inseparable from the real estate, even though it was not real property, they would treat it as real property for purposes of the income and asset tests. Right. So the regulations have a number of examples that are very helpful in clarifying what is and what is not real property. The first item they covered was above market leases, and they said that above market leases would be treated as good real estate so long as it produced good real estate income. And that's example number 11. Billboards, to the extent that a Section 1033G election was made, would be treated as good real estate. Data centers and storage structures were also treated as good real estate, and that you can see in example 5 and example 6. So we have our first polling question.
Thank you, Craig. So the first polling question of the webinar is up on your screen, and it reads, is a license to run a casino or racetrack real property? Yes or no? Please make your selection now and be sure to click the submit button to get credit for your answer. Let's take a look at the results. Okay, so 60.8% of the audience said no.
Okay, that is correct. So 60.8% of the respondents correctly answered that a license to run a casino or racetrack, even though you're running that within real estate, is not a good real estate asset. And there is an example number 13, that directly covers this issue. And basically the logic is that it is a license to operate a business. It is not, in effect, a leasing of real estate business. So even though it takes place in real estate, it is not a good real estate asset. So the audience was primarily correct. The next topic we're going to cover are what amounts are excluded from rents from real property. So we've covered what are rents and what is real property. Now we're going to talk about things that, in layman terms are rents from real property, but because of specific REIT rules are not treated as rent from real property, or what we know as bad rents, bad income. Okay, what amounts are excluded from rents from real property? So the first item we're going to cover are related party rents. So related party rents are defined as rent that you receive from a tenant where that tenant, where the REIT owns directly or indirectly a 10% or greater interest. What that means is that a REIT can own the tenant directly, own stock in that tenant, or has an interest in that tenant of more than 10% or more, if it's a partnership, or the REIT owns the interest indirectly, and that requires the application of complex constructive ownership rules. So one example is when a REIT has a 10% or more shareholder, and that shareholder happens to own 10% or more of a tenant. So in that situation, even though the REIT has no interest in the tenant, because it has a 10% shareholder, and that 10% shareholder owns 10% or more of the tenant, the ownership by the 10% shareholder will be attributed to the REIT, and the REIT will be deemed for this purpose to own 10% more of the tenant and therefore have related party rent. So that's known as single attribution. There is a more complicated situation where the REIT has a 10% shareholder. That 10% shareholder is a partner in a partnership with a third party. That third party happens to own 10% or more interest in the tenant. And in that situation, because of double down attribution, the REIT is deemed to own, in effect, what that unrelated third party owns in the tenant and therefore has related party rent. So in that situation, the 10% shareholder did not own an interest in the tenant. The REIT did not own an interest in the tenant. Some third party owned an interest in the tenant, and the REIT still had related party rent and bad income, and theoretically, depending on the size of that bad income, could cause the REIT to fail the gross income tests. The third situation, and unfortunately a more common situation these days, is when a tenant, especially retail tenants, have trouble paying their rent. There's some sort of workout, whether in bankruptcy or not. The tenant issues an interest in itself to the REIT, and if the REIT owns more than 10% of that economic interest, or that tax interest, the REIT will be treated as having related party rent from that tenant. So where the REIT was just trying to keep the tenant afloat, trying to just work out with the tenant, it turns out to have related party rent, which is a direct ownership of the tenant. And the last situation is a TRS, by definition, is a related party to a REIT, and therefore any lease to the TRS is potentially related party rent and not good income. However, there are certain exceptions that Don will discuss in section number 5. The good news is that legislation has been introduced in the House to correct the situation. So hopefully that legislation will pass, and some of these situations where the REIT should not have bad income will be relieved. The second area where we can have bad rent is rents based on profits. As we said earlier, a REIT is supposed to be in the rental real estate business. It is not supposed to be in the business of the tenant by sharing into the tenant's net profits. So there is an exclusion in the regulations that say the REIT can share in the tenant's gross receipts, so long as it's really gross and not net. And that gets into a question of if you want to make exclusions from what is gross receipts, you need to read the regulations as to what is and what is not permissible. There's also another requirement, that regulation, that says that if you're going to rely on a percentage of gross receipts, that percentage must be fixed at the time the lease is entered into. It cannot be renegotiated during the term, and it has to conform with normal business practices, which has been a issue that some of us may have had to face given COVID and given what has happened to especially hotel businesses, where the lease between the REIT and the TRS is almost always to some extent based on percentage of gross and whether or not you can renegotiate those terms without violating rule number 1. There's a third piece that you should know, is that there is a revenue ruling that says just because one tenant's lease is disqualified, it does not taint the other tenant's lease. So that one bad lease in a building will not taint the rest of the building's rents. And I've listed some examples of good rent versus bad rent. You can read those, and it just deals with common situations of subleasing and a percentage of gross rates and when it qualifies and when it doesn't. The next item are short-term rents. As we said earlier, there's no time limit stated in the code as to what is the time limit for something to qualify as rents from real property. There is a revenue ruling 98-60, which involves short-term leases for guest apartments. And in that ruling, the IRS ruled that those leases, even though they were short-term, created good rent to the extent that the services to those tenants for their convenience did not exceed that 1% diminished threshold that we referred to earlier. Unfortunately, they did not publish what was considered a short-term lease, so it provides limited guidance as to what the term should be. There are a bunch of PLRs that talk about short-term rent not tainting all the rents to the extent they're only 1 to 3% of the total rent, and those are mostly in the billboard context. There are agreements that are treated as long-term, even though the tenant may only use it for a short term, so long as the term of the lease is long-term. And the IRS's unofficial position for private letter ruling purposes is that the lease needs to be 30 days, even though, as I said, that is not in the code, the regulations, or in published guidance. Similarly, there's no space requirement listed in the code. It doesn't say it has to be exclusive use, non-exclusive use, whether you can share the space, not share the space. And as the REIT world has gotten more complicated, we know that the landlord is now trying to optimize the use of the space, and that may involve renting space to multiple tenants, which is common in the billboard advertising situations, in the fiber optic cable situations, and cold storage facilities. And there are private letter rulings that sanction non-exclusive use. However, the IRS's position is that you can't provide overcapacity to one user. You can't basically take away somebody else's use to provide more use to somebody who's already contracted for a certain space. Which brings us to our second polling question.
Thank you, Craig. So the second polling question of the webinar is up on your screen, and it reads, can a REIT receive rents from a hotel if it hires an IK or TRS to provide all services? Yes or no? Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it just a couple more seconds. Be sure to click submit. Okay, let's take a look at the results. 77.6% of the
Okay, the IRS's position is that a REIT cannot receive rents from a hotel, even if it hires an IK and a TRS to provide those services. Even though we have talked about if you use an IK or TRS to provide the services, that would be allowable, the IRS's position that rents from a hotel are short-term rents and they do not qualify as rents from real property, even if you use an IK or a TRS. Now, there are many in the industry who think the IRS is wrong, but that is their position on this topic. So I think you're right. The IRS doesn't, but that's to be dealt with in the future. Next, I'm going to turn it over to Don to talk about Impermissible Services.
Thanks, Craig. So I'm going to talk about permissible services, which are important for a REIT to provide. But first, just a really, really quick review. As Craig said, there are basically 4 exclusions from rents for real property. Related party rent, where rents derived from a tenant which the REIT owns an interest at 10% or more. The result here is that the rent from that particular lease is bad income. Rent from a net profits lease, where rent from a lease is based on a percentage of net and not gross revenues. Once again, the rent from that lease is not good income. Rents from personal property, again, the rent from personal property is not good rents. And finally, impermissible tenant service income, which is income derived from the services a REIT provides to the tenants, which is not customary or is for the convenience of the tenant, which we're going to go into a little bit later. But with respect to this last category, the result is much more severe. If only a small amount of income is derived from, for example, one tenant in a 100-tenant building, all of the rental income from the building, not just that tenant, all the rental income from the building is disqualified and is not good rent. And in a REIT with maybe only a few properties, this can result in a disqualification of the REIT. So you can see how important permissible services are for a REIT to provide. So 2 tests must be met for the service to be permissible. 1, must be usual and customary for properties of a similar type and class in the same geographic market. The service provided by the REIT also must not be primarily for the convenience of the tenant. And if they're both satisfied, then all the revenue from provision of these services results in qualified rent, even if the REIT marks up the services and retains a small profit. Again, what does the term of convenience of tenants mean? Well, that's borrowed from the unrelated business taxable income regulations. Basically, they're provided for a tenant's convenience and are other than those usually or customarily rendered in connection with the rental of rooms. Typical example is maid service. That is provided for the convenience of a tenant. On the other hand, heat, light, utilities, cleaning of public areas are not. And the focus is on a particular tenant. Now, what are permissible services? This list is right from regulations from both the REIT and the UBTI area. You can see they're pretty common: water, heat, light, air conditioning, laundry equipment, parking facilities, etc. These are right from regulations, and the theory is these are so common all over the United States that they are permissible services. But what the regulations say, and as Craig said, they have not been updated for at least 30 or 40 years, is an independent contractor must be used to provide these. And in fact, these days, it is not true, as we'll go into a little bit later. So over and above this, there are private letter rulings that have said certain services are permissible as well. And this is a little bit higher than what the regs provide. Preparation of space to allow for new rental after a tenant vacates, so snow removal and improvements. There's review of tenant construction plans, as long as the REIT doesn't do the construction itself. Freight elevator, overtime HVAC, etc. And once again, these are from private letter rulings. Also, for the regulations, the fiduciary duties of the trustees or directors can be done without an independent contractor. And these duties relate to managing the REIT itself, as opposed to furnishing or renting services to the tenants. For example, trustees can establish rental terms and leases, choose the tenants, deal with taxes, interest, insurance, make capital expenditures for the safety and security of the property. So this brings us to what are impermissible services, where the REIT may run into trouble if it provides them. So it's impermissible if it's obviously the opposite of permissible. It's not usual or customary provided to the tenants, or it's rendered primarily for the convenience of the tenant, and the REIT does not use an independent contractor or a TRS to furnish the service. And once again, the risk is that all of the rent from the entire property, not just from the lease to the tenant, becomes non-qualifying rental income. There's a 1% exception we're going to go into in a couple of minutes. Here's some examples of impermissible services from private letter rulings. Concierge in the building that goes beyond giving general information, decoration of a tenant's space while the tenant is in the space, redesign or modification of the space, tenant improvements which are non-administrative, and so on. There are many, many others. I just want to list a few here. As you can see, these are way beyond what the regs permit and what the other private letter rulings permit as well. Now, we said impermissible services have to be furnished by an independent contractor. What is an independent contractor? So it's an entity that cannot be an employee of the REIT, It may not own more than 35% of the shares of REIT, or the owners that own 35% of the REIT can't own more than 35% of the independent contractor as well. Now, there's a dichotomy of the requirements for an entity to be an independent contractor based on whether the services it provides are customary or non-customary. If it provides customary services, which frankly the REIT can do by itself anyway, the REIT cannot derive any income from the independent contractor, including dividends and interest. It must be an arm's length relationship, and the independent contractor must be adequately compensated. And an unadjusted percentage of gross rents works, but an unadjusted percentage of net rents does not. Cannot be an employee of the REIT. REIT cannot control how the duties are carried out, and the cost of services may be borne by the REIT. On the other hand, if the independent contractor furnishes non-customary services, then the rules are a little more strict. The independent contractor must bear the cost of the services. It must receive and retain a separate charge. And just like the customary services qualification above, it pays no income to the REIT and it receives adequate compensation. If these are not met and the service is non-customary, then the service will be looked at as provided by the REIT itself, and it may taint all the rents related to that property unless it satisfies the Minimus rule or provided by TRS. Again, we're going to take that up in a couple of minutes. Let's talk about parking and amenities for a second. So REITs have issued many rulings on parking because there are many parking structures. In 2004, however, the IRS issued a revenue ruling which basically showed its thoughts about how parking services should be rendered in several different situations. So the common facts are that it rented those properties. Each property also included parking spaces for the use of the building's tenants and their guests. It was located in or adjacent to the building occupied by the tenants. It was appropriate in size, which we'll get to in a couple of minutes. And the customers and the subtenants were expected to use the facility according to the size. Now, in the first situation, the parking facilities were unattended. The REIT provided maintenance and lighting. The fiduciaries provided insurance coverage. This was held to be rents from real property. Situation 2. Now the REIT provided reserved parking spaces for a fee. It marked and assigned the spaces. It enforced the spaces by having a towing company tow cars, and that towing company was an independent contractor because either it was not customary in the area or it was for the convenience of the tenant whose parking spaces was taken and it shouldn't have been. Finally, in the third situation, now the REIT provided many more services to parkers. There were extra spaces rented to the public. It had parking attendants. Sometimes they performed small services like jump starting a dead battery or fixing a flat. Here, the independent contractor managed the lot, employed all the personnel, and remitted the parking fees to the REIT and was adequately compensated for the REIT. Once again held, this was rental income to the REIT. Now remember, the rule is that the REIT cannot derive any income from the independent contractor. Here, the independent contractor did remit the parking receipts to the REIT, but here the independent contractors looked at as a conduit for transferring the parking fees to the REIT, and as long as it provided the services, there was no impermissible tenant service income. What it means is when the REIT cannot derive income from an independent contractor is a percentage of the net income of the contractor itself, its revenue minus its expenses. So the parking taker rates. The more services a REIT provides, the more it needs an independent contractor. The location of the parking, the Rev Rule and several private letter rulings use the term in or adjacent to. So a parking facility underground, above, within the property is okay. Adjacent to, a service lot next to the building, even across the street from a property is generally okay. But standalone parking, either a block away or several blocks away, there's no clear guidance on that yet. The term then is used appropriate in size for tenants, their guests and customers. What does this mean? Well, basically consult the municipal code, which may say, well, 4 spaces per 1,000 square feet rented in an office building. If it goes higher than that, the risk is that the REIT is engaging in a separate business, the parking business, and not getting rent from tenants, but getting fees from the general public. There's two private letter rulings here that IRS issued favorably, where the taxpayer represented that members of the general public were not expected to use a parking facility because all the other buildings in the area were required under the municipal code to have their own parking facilities. Finally, just want to talk about furnishing other services. And the IRS ruled in 2018, a fairly important private letter ruling, that there's a difference between providing a facility and providing a service with respect to that facility. For example, the facility can be provided as a swimming pool, exercise room, lounge, kitchen, whatsoever. That's a facility, and that's fine. However, if in addition, REIT provides a lifeguard, a weight training coach, a cook, that goes above and beyond facility, and that is a service. And that has to be tested against the requirements of customary and not for the convenience of the tenant. So here's a schematic. Who may perform the services? Basically, the upper left quadrant, the service is geographically customary, and it's not for the convenience of the tenant. These services can be performed by a REIT directly, or an independent contractor, or a TRS. All the other quadrants, either the service flunked one or the other test, or both. In all these, a REIT needs an independent contractor or a TRS to provide the impermissible service. Finally, we talked about the 1%, the Minimus rule. What that says is, even though there's an amount of impermissible services provided to tenants at the property, there's no issue if it's not more than 1% of the gross income of the property. So what if a REIT provides these services, but there's no charge? There's an amount of income which is deemed to result. And the value is deemed to result by taking the cost, the direct cost of providing the service and multiplying it by 150%. Direct costs are generally direct materials and labor, but not overhead. And this is a property by property calculation. Example, small example here. At the request of an office occupant, the building services enters the office, hangs a personal painting. Part of the wall has to be respackled with painting after the hanging. The cost of the REIT and the employee is $50. He worked for 3 hours, and the materials are another $100. So the value that adds to $150. Multiplying that by 150% equals $225. If that is less than 1% of the total gross income of the property, then it's not viewed as impermissible tenant service income. There's no issue with disqualifying rents from the property, even though that value goes into the 5% bad income bucket. I see now we have another polling question. Sean.
Thanks, Don. So the third polling question of the webinar is up on your screen, and it reads, have you dealt with services where you had to consider whether they were customary in the area or were for the convenience of the tenant? Yes, no, or unsure. Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it a couple more seconds. Be sure to click the submit button. Okay, let's take a look at the results. 49.4% said yes.
Okay, that's probably representative of REIT population as a whole. Many people have to deal with the services. So in a triple net lease, you really don't have to because the tenant provides all of them for itself. So I'm now going to turn it over to Patrick, and he's going to discuss what is a taxable REIT subsidiary.
All right, thanks, Don. So taxable REIT subsidiaries, we would find taxable REIT subsidiaries sitting below a REIT or an operating partnership of the REIT in a common REIT structure. Unlike other corporations, a REIT can own up to 100% voting and 100% value of a taxable REIT subsidiary. You'll notice these are two exceptions to two of the common REIT security tests, the 5% and the 10% test. A brief overview of these two tests is that the general rule is that not more than 5% of the value of the REIT's total assets can be represented by the securities of any one issuer. And then the 10% test states that the general rule is that a REIT is not permitted to hold securities possessing more than 10% of the total voting power of any one issuer or having a value of more than 10% of the total value of outstanding securities of any one issuer. So owning a taxable REIT subsidiary is an exception to these two tests. What is the reason for a TRS? So why use a taxable REIT subsidiary in the structure? Well, they allow a REIT to engage in otherwise problematic activities that generate problematic income. For example, what Don and Craig just discussed earlier in this presentation. However, even though the subsidiary corporation is accepted from the 5 and 10% security tests, taxable REIT subsidiaries are still subject to other REIT asset tests and gross income limits. Some of the asset test, the 20% test, which states that the value of all TRSs within the REIT cannot exceed 20% of the REIT's gross asset value. And then the income test, so for the 95% income test, dividends from a TRS to the REIT are good income for purposes of the 95% test. And then for the 75% REIT income test, dividends from a TRS to the REIT are not good income for purposes of the 75% test. Therefore, TRS dividend income can constitute up to 25% of the REIT's income. It's a way to convert bad income into not so bad income. And TRSs were originally commonly used to facilitate types of income that were service of nature, but now, TRSs have expanded greatly in their use to alleviate other REIT structuring issues. So what is a taxable REIT subsidiary defined? A taxable REIT subsidiary is a corporation other than a REIT, and the REIT directly or indirectly owns stock in the corporation. For example, the REIT can own an operating partnership, and the operating partnership then owns the stock of the TRS. A TRS is an election. The REIT and such corporation jointly elect that the corporation shall be treated as a taxable REIT subsidiary by filing Form 8875. For effective date purposes, the effective date of the election cannot be more than 2 months and 15 days prior to making the election. For example, if you wanted to be treated as a TRS starting on 1/1 of a year, you would have to make the election on 8875 by March 15th. The effective date also cannot be more than 12 months after the date the election is filed. I also want to point out that another election that may need to be considered is that a lot of TRSs are organized as check-the-box limited liability companies, so a Form 8832 to elect corporation status would also be needed. A TRS can be a foreign corporation, unlike a REIT that must be domestic. A TRS cannot file a consolidated return with the REIT, but it can, do consolidated GAAP financial statements. A TRS is different from a qualified REIT subsidiary, and it should not be confused as a qualified REIT subsidiary because a qualified REIT subsidiary, all its assets, income, et cetera, are treated as if owned by the REIT directly and are ignored and are subject to all of the regular REIT asset and income tests. What type of entities cannot be a taxable REIT subsidiary? A REIT itself can't be a taxable REIT subsidiary, and TRSs are not permitted to directly or indirectly operate and manage lodging or healthcare facilities or license or franchise brand names for lodging and healthcare facilities. To do these type of activities, a TRS must engage in an eligible independent contractor, which I will touch on shortly. Some advantages to using a TRS within a REIT structure. Like I said, it allows the REIT to own more than 10% of voting and value of the corporation. It is a mechanism to provide services to tenants that may be non-customary or for the convenience of the tenant that would otherwise be bad income to the REIT. This would alleviate the need for the REIT to engage an independent contractor and would not be subject to the 1% de minimis test, as Don explained earlier. TRSs can generate what would otherwise be bad REIT income and convert this income to be not so bad REIT income for purposes of the 95% test. Remember, as I discussed on a previous slide, that dividends from a TRS would qualify as good income for the 95% test, but bad income for the 75% test, essentially increasing certain types of bad income limitations from 5% to 25%. Some types of bad income that are commonly derived in a TRS that you would find would be third-party management fees, development fees, sales of dealer properties. Using a TRS can escape the potential for 100% excise taxes on prohibited transactions. The trade-off to this is, the TRS is subject to a 21% corporate tax, the regular corporate income tax rate, on its income. And it can be accepted from the related party rent rules with respect to leasing a hotel or healthcare facility from a REIT, which we'll talk about on a following slide. Disadvantages to operating a taxable REIT subsidiary, like I mentioned, they are subject to the regular 21% corporate income tax rate. They are limited to 20% of the REIT's total assets, subject to certain excise taxes, and a TRS can create additional complexity in the administration of the REIT. For example, it creates more tax returns and compliance considerations within the REIT. I'm going to turn it back over to Don now to talk about the related party rent rules and TRSs. Don, are you there?
I am here. Sorry, I had my phone on mute. So the last advantage on Patrick's slide of the TRS was that it's an exception to the related party rent rules. In other words, a TRS can lease property from a REIT, even though the REIT owns much more than 10%, frequently 100% of the REIT, which is a tenant. So there's two exceptions. There's a lodging and healthcare exception and the 90% lease exception. So REITs rents, in the lodging and healthcare exception, if a REIT rents to a TRS, one of these qualified lodging facility or qualified healthcare facility, and the property is operated on behalf of the TRS by what's called an eligible independent contractor. This is different from an independent contractor because the eligible independent contractor must be otherwise independent contractor who at the time of execution of the agreement with the TRS to operate the property is already engaged in the trade or business of operating qualified lodging facilities or healthcare properties for any person that's not otherwise related to the REIT or TRS. The 90% lease exception says that, once again, a REIT can lease property to the TRS as long as the TRS as a tenant does not own more than 10% of the leased space. And once again, this is an exception to the related party 10% ownership rule. In this case, the rents that the TRS pays to the REIT must be substantially comparable to what the REIT's other tenants pays. A transfer pricing study is frequently used to support the rental rates and comparable space. I added a private letter ruling at the bottom because it was just issued, I think 2 weeks ago. Here, a REIT leased capacity on its fiber optic cable to a TRS, which was less than 10% of the lease capacity. The IRS basically said that this fiber optic cable was, in effect, real estate, and the TRS did not rent more than 10% of the space in an identified geographic region. So that's a pretty expansive view of what real estate is, and the TRS was able to use it so as not to create related party rents. Well, here is the typical structure of the lodging and healthcare exception. We have a REIT owning 100% of the TRS, which leases the property, or here a hotel, from the REIT. It then engages an eligible independent contractor to operate the property. So frequently, REITs and their TRSs have transactions between them. So how must the expenses between them be shared? So the allocations between these two entities must be reasonable and should be documented. Once again, a transfer pricing study is accepted and frankly expected by the IRS to support these allocations. There are penalties for misallocation of costs between the REIT and the TRS. It's a 100% excise tax that applies to the amount by which the REIT understates its deductions and overstates those of the TRS. So taxes imposed on the excessive amount of, first of all, the rental income received by a REIT, which was higher because the TRS provides services to the REIT's tenants. And here the theory is, well, maybe that extra rent really should have gone to the TRS as service income, which would create taxable income at the TRS level on which would have to pay tax. I'm just going to slip 2 slides. These are safe harbors to what I just mentioned. And you might see for items 1 and 4, related to what we discussed before with the 1% de minimis amount. 2 and 3 basically say that the TRS has to treat other tenants the same if it rents to other tenants, or if it rents to the REIT's tenants, leasing at least 25 of the space, they have to pay substantially comparable rents by tenants who lease comparable space who don't receive such charges. Outside of this, the rental income, which called the REIT-determined rents, there are deductions of the TRS for payments made to the REIT for overhead, REIT-determined deductions. Once again, if they're too high, the IRS can reallocate and reduce those deductions. Interest paid by the TRS to the REIT, the IRS, once again, can reduce the amount of the interest if it's not a commercially reasonable rate. And redetermined TRS income, which is actually income paid by the tenants to the TRS, but which is not high enough, it should be higher. The IRS can advocate for that too. So, with all that said, and once again, the TRS and the REIT have relationships between them. How does the TRS get the income up to the REIT? It can distribute a dividend, which Patrick pointed out is 25% income to the REIT. If the TRS has no earnings and profits, there's no dividends, dividend tax on the TRS, and there's no income to the REIT either. It goes against the basis of its stock. The REIT can make a loan to the TRS, and the TRS pays interest. Once again, it can't be excess interest. The IRS can come in and reallocate, and it's limited by the 30% deduction unless the TRS elects to be a real property trade or business, and the penalty for that is depreciating any property it owns under the ADS system. Finally, the interest of, quote, leakage is raised, which basically is, can a TRS show losses every year? Can a TRS show no income every year? It's a taxable entity after all, and the IRS is expecting tax from a C Corp. So there's a rule of thumb that a lot of practitioners use, which is 3% leakage, which means a TRS should show maybe a 3% profit every year. And so that shows the IRS that this entity does make some profit. The downside is, if it's just an artificial amount that's, you know, the items are revised every year to try to come to that, the IRS will say it's, you know, business should be business. Sometimes an entity, any entity, will make money one year, lose money another year, sometimes break even. And so basically, you know, taxpayers are advised that business is business, let that take the TRS where it may. Finally, I see we have our last polling question. Sean, I'll turn it over to you.
Thanks, Don. So the last polling question of the webinar is up on your screen, and it reads, have you had experience in forming a TRS to perform any of the functions we have discussed? For example, perform non-customary services to REIT tenants, serve as a mechanism to dispose of REIT-owned property to avoid the prohibited transaction tax, leasee of hotel, healthcare facility, etc.? Yes, no, or unsure. Please make your selection now and be sure to click the submit button to get credit for your answer. We're going to give it just a couple more seconds. Be sure to click submit. Okay, let's take a look at the results. It's kind of close, but 52.7% said no.
Okay. You know, but 42% said yes. That means that a lot of people, at least 40%, that see the benefits of forming a TRS to take care of some of the issues we discussed today. And for the other 53%, I hope that this presentation will show you that the TRS is a very, very valuable tool that can be used to solve a lot of REIT issues. I'll now turn it back to Craig.
Thank you, Don. As we wrap up, I just wanted to thank everybody for their attendance. I'd like to cordially invite everybody to webinar number 3, which I think everybody will find interesting. We're going to cover a number of special REIT structures, including up REITs and down REITs and baby REITs and RIDEA lease structures. And we're going to look ahead to whatever tax legislation and rulings have been issued, will be issued in the next month. So please join us for our next webinar on October 5th at 12 o'clock. And hope everybody enjoyed the webinar and have a good day.
Thank you, Craig. So we hope everyone enjoyed today's webinar. Thank you once again to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see those instructions on the screen now. If you're a Mazars employee, no need to download the certificate. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on the screen shortly. Please take a minute and click that link once we conclude here. We hope you will join us on our next webinar, the next webinar in this series, and it's on October 5th. Please click the button on the right-hand side of your screen to register now. And, we invite you all to please reach out to any of today's presenters or myself with any further questions. Thank you once again, and enjoy the rest of your day. Stay well, everyone.